Welcome to Charts That Count. Once upon a time, there was a group of mean old hedge fund managers who got together and sold short a sweet, innocent little company called GameStop. GameStop sold games, for goodness sake, to children. But then a brave group of handsome young retail investors banded together, forced the price of GameStop shares up, and drove the wicked old fund managers out of their short positions. This left the predatory hedge fund managers with big losses, and the retail investors made big profits, saving GameStop. Hooray! The end. Of course, the real story is a little bit more complicated than this. For one thing, there's actually quite a number of shares, not just GameStop, that are jumping on heavy retail buying activity. For example, BlackBerry, Bed Bath & Beyond, and AMC Entertainment. Like GameStop, these are all smallish companies that have not been doing particularly well, and most of them have attracted a lot of attention from short sellers. But not all of them. BlackBerry, for example, has quadrupled, despite having quite low short interest. And what's more, even as the biggest funds who had short positions in GameStop have exited, 40% of the shares are still sold short. As some skeptics have left, others have replaced them. This is not a simple short squeeze, and the game is still on. And on that point, about retail investors getting rich. Remember, this is a zero-sum game. Some retail investors do have big paper profits they've won at the expense of the pros, and this is good fun to watch. But GameStop is an unprofitable company with only slender turnaround prospects. The shares will come down, and come down hard, at some point. Who will be holding them when they do? This is no fairy tale. Instead, it's a children's game called musical chairs.